Hello and welcome to CMS Forex News. I'm market analyst Nick Nassad. Today is Wednesday, July 15, 2009. The dollar was sold off today as better than expected U.S. corporate earnings have reduced risk aversion combined with pressure from Russia and China regarding reserve diversification. The near-term outlook for the Greenback has therefore deteriorated compared to the beginning of the month. The euro-dollar rallied above the 1.40 level, which it was testing yesterday, and rose above the 1.41 level around noon New York time. Today's price action broke out of a triangle pattern that has set up for the last 5 sessions. Stocks were high around the globe in today's session, with European indexes seeing strong gains of 2 to 3%. Stocks in the U.S. opened higher as well, with the Dow Jones up 2% or 180 points by noon New York time. That helped propel higher yielders like the euro against the yen. The euro extended its rally against the yen from Monday, breaking above the 130.80 level, which has acted as resistance the past 4 sessions. The rally accelerated in New York trading, retesting the levels from last Tuesday. The decline in the greenback today was especially evident in commodity currency pairs like the Australian dollar-US dollar pair. This week has seen the Aussie rally about 350 pips since hitting a low on Monday near 0.77. A rally in global stocks and commodity prices is behind the move. Here, like in the euro-dollar pair, we saw a break of an important short-term resistance trend line. The US dollar-Canadian dollar pair, which also relies on risk sentiment, extended its gains from the last 2 sessions to fall to the 1.1120 level in mid-New York trading. The fall since Monday's open has amounted to 535 pips. This pair saw a break of important support in yesterday's trading, and today's decline in favor of the loonie brings the pair to its lowest level since June 14th. In fundamental news from the U.S., consumer prices rose 0.7% in June, a figure that was mostly expected, though it was slightly higher than forecast. The increase was largely due to higher gas prices. On an annual basis, prices continued falling, sliding 1.4%, the largest drop since 1950. Prices rising on the month were not enough to move the annual figures away from their declining trend, which means the risk of inflation is not enough to move the Fed from their near-zero interest rate policy. Still, the monthly figures also deflect some of the worries over deflation, as we have now seen a 6th straight month of positive readings in the core rate. The New York Empire Manufacturing Index improved to negative 0.6, a better than expected result. The new orders index rose above 0 for the first time in several months, and the shipments index also climbed into positive territory. Industrial output in the U.S. declined 0.4% in June, a figure that was better than expected, but is still the 8th straight month and the 17th month out of the last 18 that production has been down. The figure, though, is still much smaller than May's revised 1.2% drop. The UK economy continued to shed jobs in June, but the 23.8 thousand increase in workers laid off and now receiving unemployment benefits is the smallest increase in unemployment in nearly a year. That data can add to the sense that the worst of the recession in the UK is over, but still the recovery is expected to be slow and gradual. The pound-dollar pair was higher prior to the UK jobs report and extended its gains following the better-than-expected result. Today's rally amounted to 160 pips, and similarly to the other pairs we have been focusing on, broke above its resistance level from last week. Tonight, Japan will release its Tertiary Industry Activity Index, a measure of the services sector, and follows that up with its Bank of Japan monthly report. The fundamental docket is light during the European session, with only Switzerland releasing its ZEW Expectations Index. Tomorrow, the U.S. will post its weekly jobless claims figures, a report on foreign capital flows, and the Philadelphia Fed Index. And that concludes our broadcast for today. Thank you for joining us here at CMSFX.com, and happy trading.